The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Hello and welcome to another episode of Something More with Chris Boyd. My name's Jeff Perry and I'm sitting in for Chris this week, who's off on vacation. I'm an investment advisor representative with Asset Management Resources, and we do this show and podcast every week and have a different guest on talking about something regarding our financial life. And I'm very pleased to have with me Brian Regan, who's our chief I always get this wrong, Brian. I'm so used to saying chief financial officer, our chief investment officer. And let me introduce you a little bit more, Brian, before we go, because it seems like, you're a very frequent guest. You're our expert here at Asset Management Resources, and we have you on to talk about the economy, the markets, all things related to those and others. And sometimes we just say Brian's with us, and for our listeners of long-time listeners, they know who you are, they know your credentials and your education. But let me give you a more formal introduction to our listeners who may have not heard your introduction before. As I said, you're our chief investment officer. You're a chartered financial analyst, which is a high-ranking designation for people who make these financial decisions. At a firm, for a company. You have an MBA. How long have you been with Asset Management Resources, Brian?
I believe almost 6 years, but don't quote me on that. But I think it's almost 6 years, yeah.
And you also, I said you have an MBA from, I believe it's Boston College, correct?
Correct.
And tell us a few things that you did before you came to Asset Management Resources, like a little introduction to the listeners who maybe don't know you as well as some other listeners.
Sure. So I've done a variety of different kinds of investing in my life. I consider myself a generalist. I started my career at a bank, State Street Corporation, in the Treasury Department, where I did a lot of what we call balance sheet consulting, helping business units determine what kind of deposits they want to bring in that case, what kind of currencies, where we're going to make the most money with the certain currencies. After a few years there, I moved on to EMC Corporation, where I helped manage $15 billion in corporate cash and a variety of fixed income strategies that I created with my colleagues. And we hired external managers, reviewed external managers, sometimes fired external managers, and a great way to learn about fund research, manager research, and really cut your teeth in the fixed income market. During that time, I finished the CFA. I passed the third level during my time at EMC. EMC was eventually bought by Dell.
Right.
The money that I was managing was going to be used as part of the transaction. And I needed to find another job. I became a management consultant for a couple of years, which was basically going into failing companies, working with them operationally to try to create some, necessary cash flow to survive and to fund on the next part of their business plan. I did that for a few years until I needed to come home. You are on the road 6 to 7 days a week in that
Sure.
role.
Yeah.
And that's when I came back to Boston and joined Asset Management Resources, where I've been for 6 years, and my primary role is directing the asset allocation, whether it be for individual stock portfolios or for ETF mutual fund portfolios, which utilizes experience that I've had in the past, like fund research and individual stock research, which I've learned a lot from restructuring. And during that time as well, I finished my MBA. So at Boston College. So I guess that brings us up to today. Probably more than you wanted to know.
No, it's exactly what I wanted to know, because we have our members of our team on these episodes and our guests, but primarily members of our team, and we give our thoughts and our suggestions, and we turn to you for, our expert opinions and commentary on markets and the economy. And it's important that people know you're more than just an employee of Asset Management Resources. You have other credentials, you have education, you have experience, and your comments are based on all of that. You're living the life. You have the credentials, and your thoughts are always well taken by me. And I think it's important that we remind our listeners of the high level of credentials and experience and education that members of our team have. So thank you for sharing it. So for this episode, I believe I wanted to pick your brain a little bit. This time of year, it's we're into the final quarter, so the third quarter is behind us, of the third quarter of the year. And you do a quarterly webinar for our clients, which you talk about the markets and the economy. That's your focus for sure. So I know you're preparing it now and getting ready for it. That's coming up soon for our clients. And this is one of the services that clients of Asset Management Resources have every quarter. They have a webinar from you on the markets and the economy and other things from time to time. And we also have a financial planning webinar, and other members of our team, including you sometimes, led by our CEO, Chris Boyd, provide financial planning information on those. So lots of information to our clients. So what are you focusing in on? It's been a good year. The last few months on the markets has been a little bit range bound, maybe a little bit tight, but overall I view it as been a good year, a great year compared to last year. What are you focusing on, and what do you think you're going to focus on for the webinar coming up?
Sure. So it has been a great year, especially for stocks, not necessarily for bonds.
Right.
And maybe a shaky September, maybe a little bit of shaky August, but overall for the year, it's been a fantastic year. You probably shouldn't expect much better than this. This is pretty good. But for the webinar, just to give some background, I think you gave a great introduction, but this is really to inform clients on any kinds of changes that might show up in their portfolio. What are we looking? What are the risks? What are the opportunities that we're seeing in the market? And how can we position the portfolio to take advantage of that? And I have a variety of slides that concentrates on what's happened in the last 3 to 6 months, and how we've positioned the portfolio, and what the data is saying now. But then I realized, as I put all this together, I thought I'm not even addressing a lot of probably the common questions that people have. So at the end of all the analysis, I have common questions. And what I realized is that these common questions are really longer term themes. And those longer term themes might not necessarily change what we're thinking about on a 3-month basis, a 6-month basis, or how we're going to slightly alter the portfolio to take advantage of an opportunity we have now. But they're kind of grander, long-term risks or opportunities, or could pose risks or opportunities in the future. And I think those are, largely what people's minds are gravitating towards. So let me give you an example.
Yes.
Geopolitics is your wheelhouse, right? And that's obviously on everybody's mind right now, as we have 2 pretty major wars overseas. We have one in Israel, who is on a full-scale assault of Gaza, and we have one in the Ukraine, as the Russians invaded Ukraine, and they're basically at a stalemate over the Donbass region right now. We get a lot of questions, and we talked a little bit about it last week about how does this affect, the markets. And, I said, hey, look, we don't really know how these things are going to affect, how they're going to spill over. We can all imagine worst case scenarios. But I think, the more forefront issues might be oil prices or food prices in the case of Ukraine and Russia. All things that we experienced at the beginning of the Ukraine and Russian war. We haven't necessarily seen big changes in oil prices so far across our fingers with the Middle East conflict right now. But those are the initial things that come to mind, and then those food and energy prices might go into raised interest rate expectations on the short end of the curve, and that has implications for other parts, other investments. But
You're absolutely right, Brian. Let me just add this: it's very frequent, normal, however we want to characterize it, for our clients to ask us questions about things in the news, right? So whatever the subject of matter that's dominating the internet, the 6 o'clock news, the news, breaking news, however people consume news today, it's very variable. But the people who worry about their investments, the people who are concerned about the breaking news, ask us these questions every day. And so I think you're absolutely right to focus on the things that they're thinking about, even if they may not be the ones that are actually impacting the market the most.
Yeah, and what I'm trying to say is they might not be impacting the market, for this webinar, but it's a longer term theme that we need to play out. So when we think about geopolitics, I don't think we need to really necessarily think about what's on the 6 o'clock news tonight, but it's good to take a step back and think about what is the history of these things and how has the market reacted over a longer time period. During the post World War II Cold War era of the Korean War into the Vietnam War, what did we see? We saw a polarized world. We saw the first world and the second world, right?
Right.
And they were completely at odds with each other. They did not trade with each other. Globalization was not nearly as robust as it was today. And for the reality is, and we were in a hot war for 25 of those years and a Cold War for even longer. What happened? Well, interest rates went very, very high, peaking, in the late 70s, early 80s, and that world order switched with the fall of the Berlin Wall, the opening up of China into the World Trade Organization, a rapid increase in globalization saw interest rates reverse completely the other direction. So, we saw that for the long term, for that 30-year period, there was one regime. For another, let's call it 40 to 50-year period, there's been another regime, and it's had a real big impact on interest rates, but not necessarily on the stock market, because over both those time frames, you can point to very, very good returns over the long time right. horizon for the stock market. So now, we might be moving into a regime that's it seems like it's not as polar, right? We're not completely free trading, maybe as we were moving towards over the last 30 to 50 years, and we're not completely polarized as we were in the post-World War II era. What we have is almost three regimes, right? We have authoritarian regimes, we have relatively free regimes, and then we have regimes that don't necessarily want to get completely involved in either world, right? Mm-hmm. And what we're seeing is that third part is actually having more and more power in the world. The first part is becoming more and more economically sensitive, right? So we're seeing the Chinese and the Russians, for example, who are authoritarian regimes. Their economies are not doing well, right? One is, waged a war for obvious reasons. They've reaped the problems that will come with waging a war with a sovereign nation. Yeah. The Chinese regime, who has built up debt loads that are frankly unsustainable, are dealing with their own issues. So we're seeing those authoritarian regimes become very economically sensitive, while it seems like the free market regimes, or the free, democratic regimes, let's call them, right, are less economically sensitive, still economically sensitive, not necessarily reaping any benefits or rewards, but kind of they just keep muddling along, mm-hmm. As you would hope, really, right? We've seen the United States actually doing exceptionally well. And then there's this third tier where you can think of like a country like India, for example, mm-hmm. right, who isn't getting involved in the regimes of the authoritarian order or the free democracy order. They're kind of in between, right? They're for lack of a better word, they're Switzerland with a billion plus people. So now there's kind of this triangular effect. It's not polar, it's not completely open, but it seems like we're almost trying to jockey for position with where we are in the world order right now. And what does that mean? Well, it probably means that we're not going to have interest rates as low as we've had them in the last 30 to 50 years. And it probably means we're not going to have interest rates as high as we did in the post-World War II era. So that's how I think about geopolitics on a grander scale. What's the longer term trend we're going to see? And the market has reacted very quickly. We went from a decade of zero real rates to now we have substantial real rates, right? We're looking at the 10-year real interest rate of around 2.5 to 2.75% right now, which is significant.
For our listeners who may be surprised at that number, could you give a definition of real rate for the people who may hear that number and think it's wrong?
Sure. So I'm not using CPI of today. You use expected CPI over the next 10 years, which I use the 5-year forward, which is at about 2.25 right now. You don't use the CPI today because a 10-year bond is a 10-year bond. It's not a 1-year bond. If you're using a 1-year bond, it would be appropriate to use, the CPI of today. So you use a 10-year bond, which is trading at 4.8, subtract 225, and that's how you get your real rate.
There you go. So you did an excellent job at talking about the geopolitics and then the trends and potential opportunities that are coming out of that. And I'm sure you'll go a lot deeper during the webinar. I want to have a broader look, though, during this segment. What other things are you looking at other than geopolitics for the upcoming webinar?
Well, artificial intelligence is obviously a big one.
Sure.
And I think that has driven the market forward in 2023. And, to much of the disappointment of the bears, it turns out that, innovation just keeps rolling along, despite what they might want to feel like sometimes. And I want to talk about artificial intelligence, but in the context of great innovations that have happened over time, right? This might have an effect that's even more exponential than some great innovations that we've had in the recent past, like the internet, for example, because it's almost like creating more very intelligent people who can work on further difficult problems and then reinform itself from the new data that's created. So that has an exponential effect on intelligence, which can be a scary thing. It's just why they about it in Congress, but can also be a great thing if it's done in a good way. I mean, you can easily see how this could further research in basically every single field, quickly and better than we've ever had before. And those types of things are really exciting. And if you want
to, the stories on medical opportunities are just tremendous. Not even thinking about the investment side of it, which I know you think of, and we all should think of, and the productivity side, but like quality of life stuff.
I think anybody who's tried to understand how this works a little bit, they can't help but to be really excited with the prospects of it. I try to use AI in different ways in my everyday life now, and I'm more and more amazed every day with what I can do today. And when I start thinking about the implications or start listening to people who are much smarter than me talk about the implications of what we'll be able to do 10 years from now, I think it's really mind-boggling, but also exciting. So I put this in the same bucket as for, what did the internet do to us right now? If you look at the retail sales report that came out this week, almost $1 trillion of retail sales comes from e-commerce now. So just that's a mind-boggling statistic that we would never have thought was possible in the early 1990s. Not too far away. We can I can hop on an airplane right now and get to California in 6 hours. And before the Wright brothers, that was viewed as science fiction, right? Yeah. So I put this as what I think this is going to be one of the great innovations of all time. I don't think it's something that I have a particularly exceptional handle on working on it every day on what the implications are going to be. But nevertheless, this is exciting. And, I want to put this in context. I was not at all excited about the cryptocurrency,
No, you weren't. It's on record early and numerous times.
So I think there are manias to get excited about, and there's manias to not be.
So what are you most excited about? Are you most excited about So the benefits of society, I know might be your answer, but let me narrow my question. From the financial analyst side of you, are you more excited about the individual companies that may, their profits may increase because of how they use AI, or are you most excited about the broad technologies for the entire country? What are you zoning in on for this webinar, or is it everything?
Well, I think there's a short-term and a long-term answer to that question, right? I think you're going to see this translate into shorter-term efficiencies and growing profit margins.
Mm-hmm.
Maybe not in the next quarter, maybe not in the next year, but over time, people are going to figure out how to utilize large language models, for example, to make their customer service more efficient. I think
Right.
that like low hanging fruit, for example, right?
Mm-hmm.
Zoom is working on this every day. They have been working on it for a while, where if you have personal manuals in your work, for example, you can train your manuals against a large language model, and your own employees can actually query your own manuals and get real live commentary back from the chatbot. Not commentary that doesn't make any sense, but commentary that actually makes sense as a computer has read the whole file and can give you and spit out a real answer. So, those things I think can drive margins. I think they can drive efficiencies. Now, in the long term, I think the sky's the limit for the reasons I said. So, what am I most excited about? Probably like, hey, we have no idea where this thing's going to go. But even in the short term, I think this has real tangible benefits that are going to drive results. We got Microsoft, for example, has a huge stake in OpenAI. Google has a big stakes, and they used to own, quote unquote, own all the brain power behind artificial intelligence, and they weren't even first to market. So I'm sure they have tons of stuff to show us in time. And there's more and more things popping up every day with people who have been utilizing this stuff. That the large language models are largely, from my understanding, open source. So many people can go and utilize the things that exist out there to build on top of it. So I don't think we've even scratched the surface of the possible applications of just large language models, for example.
I'm sure our clients are going to be very interested in hearing a deeper perspective. Brian, we only have a couple minutes left of this segment. Any other general topics without going into detail that you think you're going to cover?
One thing that I think is going to come up is student loan payments. So student loan payments have restarted this month, October, and the average American, or the average, not an average American, but the average person who has a student loan pays about $340 a month in student loans. So you can imagine how that could take a sizable bite from the budget of somebody who hasn't been paying student loans for about 3 years to going back and paying that. And interestingly enough, the retail sales number gave us no reason to think that is slowing down. That the additional student loan payments are slowing down the consumer. It's only one data point, so let's not make too much of one data point. But I'm sure I'll get a lot of questions of that. And the only thing I have to point to so far is this one data point we have has shown us that has done nothing to slow down the U.S. consumer in terms of, especially going out to eat is a big one. That it was up almost 12% over the last 9 months. So that's one big one I've often seen. And budget deficits. I mean, this topic comes up constantly.
Sure.
Constantly, almost always when the Democrats in office. For some reason, it doesn't come up when the Republicans in office, even though we've been running deficits since the Clinton administration. And so far it hasn't been an issue to much of a degree. I mean, we did have a pretty severe inflation problem after the pandemic, partly because we spent a lot of money, and that was really the only time we ever saw a problem from deficits rearing its ugly head. It doesn't mean that it can't happen in the future,
right.
But so far over a long history, nothing has come to roost because of it, right? It doesn't mean that it won't in the future.
Right.
And I think this is another one of those really long-term stories, right? Like how long can we build up our debt without any repercussions?
Right.
And it's a difficult question to answer. I honestly don't have the answer. I don't think anybody on the planet really does. What what I do say is, so far in the history of the United States, it isn't an issue at all.
Brian, I think that question, as you framed it, is a great opportunity for us to have a separate podcast just on that approach to the question, and when and if it breaks. And there's a lot of ways to look at the budget debt and deficit, but unfortunately, we're out of time for this segment. Thank you for the preview on what's coming up for this quarter's edition of your commentary on the economy and markets. It's always one of the most attended webinars, and it gets the most views on our YouTube channel as well. So I look forward to attending that webinar. And for our listeners who are clients, they'll be getting a notice soon if they haven't already about attending that. And if you are not a client and think that asset management resources could help you, check us out at amrfinancial.com. Until next week, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.